Hello friends, welcome back to my channel. So, today we're going to cover money and banking. Hence, ladies and gentlemen, esteemed scholars and curious minds, consider for a moment the quiet magic resting inside your wallet or sitting invisibly on your smartphone screen. Money is perhaps humanity's most powerful abstraction, a universal language of trust that translates raw human labor into a tangible value across space and time. Today, we embark on an intellectual journey through the veins of our economy, the world of money and banking. We shall unravel how sovereign entities dictate liquidity, how commercial institutions conjure credit out of thin air, and how these mechanisms dictate the financial rhythm of 1.4 billion lives across India and above all the global market. Before the invention of currency, humanity operated within what economists term as commodity for commodity or CC economy. Imagine a farmer in an ancient Kalinga who possessed a surplus of wheat but desperately required a pair of leather sandals. For trade to occur, he had to locate a cobbler who not only possessed the surplus sandals but also harbored an exact simultaneously hunger for wheat. This friction, what we formally designate as the double coincidence of wants, imposed astronomical transactions and surge costs upon society. The inefficiency was profound, wealth was perishable, value was unquantifiable, and economic expansion remained paralyzed. Hence, money stepped into human history as the ultimate lubricant of commerce, executing four crucial functions divided neatly into primary and secondary spheres. Primarily, it served as an undisputed medium of exchange, serving the purchase from the sale. Simultaneously, it acts as a unit of account, a common denominator allowing us to state that a car is worth 5 lakh rupees rather than 10,000 kilograms of rice. Interesting? Secondarily, money acts as a store of value and a standard of deferred payments, laying the structural bedrock upon which modern banking, capital market, and long term investment depend. Why do individuals choose to hold liquid cash in hand and when they could easily invest it to earn interest? John Maynard Keynes answered this through his liquidity preference theory. Humans demand money for three distinct motives. First, transaction motive. You need cash to pay for your daily morning coffee or grocery run. Second, the precautionary motive. A reserve buffer kept for unannounced medical or family emergencies. And third, the intriguing speculative motive. Holding liquid capital while closely watching bonds market, stock market, waiting for the interest rate to adjust before deploying capital. The demand for money is therefore a delicate balancing act between income levels and interest rate. When the Reserve Bank of India measures the nation's monetary pulse, it does not look at a single monolithic figure. Rather, it categorizes money supply into distinct measures of liquidity ranging from M1 to M4. M1, known as narrow money, represents absolute liquidity, the cash circulating in your pocket and the demand deposit sitting ready in your checking account. As we move across the spectrum towards M3, which includes the time deposit of fixed deposits in commercial banks, and onwards to M4, liquidity decreases while the total economic footprint broadens. In policy discussions, M3 is the primary benchmark RBI monitors to gauge the overall liquidity landscape of India. As for your knowledge, when we talk about the M2 and M4, it primarily includes the post office savings as well as long term deposits there. Now, we arrive at one of the most brilliant yet misunderstood mechanisms in modern capitalism: how commercial banks create money out of thin air. Literally, thin air? Seriously? Oh no, come on. Commercial banks are not mere passive warehouses storing cash in vaults, neither a magician. Operating under a fractional reserve system, when an individual deposits 1 lakh rupees in a bank like HDFC or State Bank of India, the bank does not let that money sit idle. Nope. And here the magic happens. It retains a small fraction required by law and lends out the remainder to entrepreneurs, to running businesses. The loan is subsequently deposited back into another bank account, generating a brand new secondary deposit. Through this continuous cycle, a single primary deposit multiplies manifold across the economic system. Here, you have to assume few things. For example, 1. No transaction will be done in cash, and second, only check or the type of payment can be done through account to account, obviously the bank account. To mathematically appreciate this financial multiplier, consider a simple elegant formula. The money multiplier is the reciprocal of the legal reserve ratio. If the Reserve Bank mandates a legal reserve ratio of 20%, the money multiplier becomes 1 divided by 0.20, which equals 5. This means an initial deposit of 10,000 enables the banking matrix to construct a total credit volume of 50,000. Conversely, if the central bank raises the reserve requirement to 50%, that's not going to happen, but just assume, okay, the multiplier contrasts instantly to 2, shrinking total potential credit to 20,000. By adjusting this single lever, the monetary authority can instantaneously expand or suffocate the lending capacity of the entire banking architecture. So, let's come to Reserve Bank of India. Standing at the pinnacle of this financial ecosystem is the Reserve Bank of India, our central bank. Established in 1935, unlike commercial institutions, the RBI does not interact with the general public for routine deposits. It operates as the banker's bank and the apex controller of the sovereign monetary policy. As the sole issuer of the national currency, custodian of foreign exchange reserves, and financial advisor to the Government of India, the RBI holds the ultimate responsibility of safeguarding macroeconomic stability, containing inflation, ensuring that liquidity flows smoothly to every corner of our country. Now, monetary policy part 1. When the Reserve Bank seeks to adjust economic liquidity, it deploys two categories of tools: quantitative and qualitative. Among the quantitative lever are statutory reserves, the cash reserve ratio (CRR), the statutory liquidity ratio (SLR). When the RBI raises the CRR, commercial banks are forced to lock away a large portion of their deposits at RBI vaults, instantly curbing their ability to lend or create credit. Similarly, the bank rate sets the baseline interest rate for long-term central bank loans. By dialing these quantitative knobs up or down, the central bank directly regulates the quantum of money circulating through Indian commerce. Monetary Policy Part 2. In modern daily monetary management, two instruments take center stage: the repo rate and open market operations. When the RBI hikes the repo rate, as we observed during the global inflation spikes, borrowings becomes expensive for commercial banks, which subsequently raises home, auto, and business loan rates across India, cooling down excessive demand. Furthermore, through open market operations, the RBI directly buys or sells government securities. When the RBI sells government security, it pulls cash out of commercial banks, effectively draining excess liquidity from the market in a surgical, non-disruptive manner. Monetary policy. While quantitative tools act as a broad floodgate affecting the entire economy equally, qualitative instruments operate like a precision scalpel, considering margin requirements. If the RBI wishes to discourage speculative real estate buying without hurting agricultural credit, it raises the required collateral margin specifically for property loan or home loan sale. Additionally, through moral suasion, the RBI delivers a clear directive or persuasive guidance to commercial banking leadership, aligning private lending strategies with national economic priorities without needing forced litigation. The real world case study. To see these monetary concepts comes alive in recent Indian history, let us analyze the monumental policy event in November 8, 2016. We are going 10 years back. Demonetization, the word that alarms the bell. By invalidating high denominations 500 and 1000 rupees banknote overnight, the government extinguishing 86% of the country's circulating physical cash. What happened next in the banking matrix? Millions of citizens poured physical currency into the commercial bank accounts. This generated an unprecedented surge in bank deposits, driving up liquidity, boosting M3 and bank reserves, and enabling commercial banks to significantly lower interest rates to stimulate formal economic activities. The digital revolution, UPI and the cashless economy. And we can most probably say that as far as the digital revolution is concerned, it plays its role very well. In recent years, India has executed the most dramatic digital payments revolution in modern economic history through the integration of the JAM Trinity, Jan Dhan accounts, Aadhaar identity, and mobile connectivity, alongside the Unified Payment Interface (UPI). Retail transactions transformed overnight. When a local tea vendor or street merchant accepts a digital payment via QR code, it is not merely a technological convenience. It fundamentally alters macroeconomics. It increases the velocity of money circulation, expands the formal digital footprint, reduces the central bank cost of printing currency, and bringing millions of previously unbanked citizens directly into the formal financial fold. Comparative overview. To understand macroeconomics or money and banking properly, we must understand the fiscal and the monetary policy too. At the end of the day, both these have impact on the money supply, either officially or unofficially. To master macroeconomics, one must clearly distinguish between two master hands steering the nation: fiscal policy and monetary policy. Fiscal policy is crafted by the elected government through the union budget under Article 112, using taxation and the public infrastructure expenditure to direct long-term social growth. Monetary policy, conversely, is managed by the RBI and the Monetary Policy Committee, utilizing interest rate and reserve ratios to ensure short-term price stability. When both policies operate in perfect harmony, combining prudent government fiscal spending with targeted RBI monetary liquidity, an economy achieves its ultimate potential: sustainable, non-inflationary growth. So, at the last, conclusion. To conclude our masterclass today, money is far more than physical paper or metal. It is an evolving institutional technology that has transformed from primitive barter into a digital payment streams. Commercial banks operate as engines of credit expansion, while the Reserve Bank of India act as a vigilant custodian, maintaining balance between growth and inflation. Master these core equations, understand these policy levers, and you hold the key to decoding not just your macroeconomics curriculum, but the financial dynamics of the global world. We are, after all, fellow travelers on a shared quest for intellectual clarity. If you find this exposition illuminating, I invite you to lend your voice to our growing community. A simple subscription or the act of sharing this discourse ensures that the light of the knowledge reaches fellow seekers who might yet be navigating these complex concepts alone. Furthermore, you should feel that a particular nuances of this subject, perhaps the finer mechanics of credit creation or the intricate historical evolution of the monetary policy, merit a more protracted expansive treatment. I shall eagerly await your counsel in the comments below. Let us continue this intellectual journey together with diligence and an unwavering commitment to understand the forces that shapes our world. Thank you for your unwavering attention. God bless you.